Welcome to Edgemoor Investment Advisors' video presentation of our second quarter 2024 market review and outlook. I'm Gay Truscott, and I'm joined today by my colleague Steve LaRosa. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemorinv.com. Our agenda will include a review of the positive market momentum that continued in the second quarter, the U.S. economy, resilient but slowing, broadening impact of AI, some risks we are watching, our outlook for the rest of 2024, and portfolio implications and actions. And finally, we will review two selected securities we are currently buying. Let's get started. The stock market carried its strong momentum from the last several quarters into the second quarter of 2024, driving most equity indices to record highs. The S&P 500 index alone set more than 30 new 52-week highs in the second quarter, one of the highest numbers ever recorded in a single quarter. As shown in this chart, the S&P 500 posted a 4.3% total return in the second quarter, putting its total return for the first half of the year at 15.3%. This marks the second year in a row that the S&P 500 has notched double-digit gains in the first 6 months of the year. Both the S&P 500 and the Dow Industrial Average hit new benchmark highs during the quarter, with the S&P topping 5,500 and the Dow surpassing 40,000 for the first time ever. Bolstered by a combination of a resilient U.S. economy, solid corporate earnings and GDP growth, and continued strong momentum in the technology sector, the market rally that started in late 2023 has forged ahead in 2024. The bond market, as measured by the Bloomberg Barclays Aggregate Bond Index, reversed losses from the first quarter to post a slightly positive 0.1% total return in the second quarter. For the year, however, the bond market remained in negative territory, returning negative 0.7% in the first 6 months of the year. The positive equity market momentum reflects in part a U.S. economy that has remained strong and resilient. Among the bright spots, U.S. GDP growth has remained positive but slowing, inflation has cooled, and corporate earnings have remained solid. This slide shows that U.S. GDP growth stood at 1.4% in the first quarter of 2024, down from the 3.4% in the last quarter of 2023. But that slowdown may have been short-lived, as the latest GDP Now model from the Fed projects second quarter GDP growth to rebound to 2%. We'll find out when the first estimate of second quarter GDP growth comes out later this month. Turning to inflation, the story is also positive. The Consumer Price Index, or CPI, rose 3% for the 12 months ending in June 2024, below the consensus estimate of 3.1% and lower than May's reading of 3.3%. The overall drop in the cost of consumer goods and services in June marked the first such monthly decline since the start of the pandemic in 2020. Notable declines included prices for gasoline and fuel oil, which more than offset increases for food, shelter, and medical services. While many believe this slowdown in inflation could compel the Federal Reserve to cut interest rates in September, others are waiting to see a meaningful break below 3% before the Fed acts. We'll see. Finally, corporate earnings have remained solid and are projected to accelerate in the latter half of 2024 and into 2025. For the second quarter of 2024, the projected year-over-year earnings growth rate for the S&P 500 is nearly 9%, which would be the largest quarterly growth rate since the first quarter of 2022. For the full year 2024, S&P 500 corporate earnings are projected to grow nearly 11% year over year, accelerating to more than 14% for 2025. The biggest drivers are double-digit earnings growth rates projected for the communications, healthcare, and information technology sectors. But the growth is expected to become more broadly based next year, with all 11 sectors in the S&P predicted to report year-over-year earnings growth in 2025. Now let's talk about AI. One of the most compelling themes of the last year has been artificial intelligence and the race to develop AI applications across a variety of industries, from healthcare to finance to retail and manufacturing. From performing simple tasks to solving complex cognitive questions, AI has become perhaps the most groundbreaking technology of the 21st century. This presents compelling investment opportunities for investors in a variety of areas, from semiconductors to software to energy and infrastructure, all areas where we have exposure for our clients. While no one knows what the next big application will be for AI, whether it be business learning, cybersecurity, robotics, we are constantly looking for new opportunities to benefit from this transformative technology. Stay tuned. Despite all the positive news, some cracks are emerging in the U.S. economy, which we are watching carefully. While we don't believe any are serious enough now to derail the U.S. economy, we are nonetheless monitoring them closely. U.S. unemployment ticked up in June to 4.1%, from 4% in May and 3.6% a year earlier. The number of unemployed Americans grew 11% year over year to 6.8 million. And weekly jobless claims also grew more than expected in early June, pushing claims up to a 10-month high. Housing starts fell 5.5% in May, but recovered slightly in June. The positive momentum in the housing market from earlier in the year has slowed due to the surge in mortgage rates, which hit a 6-month high in May. The National Association of Home Builders stated that persistently high mortgage rates are keeping many prospective home buyers on the sidelines. And of course, there's the U.S. presidential election in November. While there's much uncertainty surrounding this election, what we know from history is that it is not likely to have a long-term impact on the equity markets. While elections can impact markets in the short term, they tend not to be long-term drivers of market performance. As this slide shows, the stock market's positive trajectory that began way back in the 1920s has really continued its upward climb through both Republican and Democratic administrations. So the lesson to investors is that we should all pay more attention to the economy and less to politics. Now I will turn it over to Steve to talk about our outlook, the implications for client portfolios, and 2 selected securities we are currently buying.
Thank you, Kay. Our outlook for the economy and markets in 2024 remains cautiously optimistic. While the U.S. economy could slow in the near term, our long-term outlook is for the economy to grow at a solid pace and for corporate earnings to continue to rise, both of which should be positive for long-term stock returns. Other positive factors could include the resolution of geopolitical conflicts, an economic recovery in China, and inflation and interest rates in the US easing faster than expected, all of which would provide additional tailwinds for stocks. Finally, the continued adoption of artificial intelligence across numerous industries and applications is expected to drive long-term growth and productivity in the US economy. Despite stocks reaching all-time highs during the quarter, investors should not assume that markets have peaked and they've missed out on a rally. Since 1950, each time the S&P 500 hit its first all-time high during a year, stocks then delivered a 17% average return for the subsequent 12 months. The only exception to this was at the start of the global financial crisis in 2007. Of course, market declines are also inevitable. However, they don't change the long-term positive trajectory of the stock market. In fact, bull markets have historically lasted much longer than bear markets, meaning that even new highs within a cycle may still be good entry points for long-term investors. As we consider current economic and market conditions, we continue to find pockets of good stock investment opportunity. We continue to invest some cash in short-term treasuries and money market funds at 5% yields, and we continue to maintain our long-term and value-oriented investment philosophy for the majority of our investments. Our disciplined approach to active security selection offers strong long-term return potential in a cost-effective and tax-efficient manner. Now I am going to present our analysis of two stocks we are currently buying. The first is Applied Materials and the second is Ares Capital. Applied Materials is a worldwide leader in semiconductor capital equipment, services, and software, with a focus on developing and selling systems and technologies for use in the front end of the semiconductor manufacturing process. As a global market leader in semiconductor fabrication tools and equipment, Applied Materials enjoys long-standing relationships with all major global chip manufacturers and has the broadest product portfolio in the industry, effectively offering one-stop shopping to its customers. As semiconductor fabrication has become increasingly complex, the company's existing relationships and insights into future technology needs have led to a steady new orders for its state-of-the-art equipment. Signs continue to emerge that a semiconductor upcycle is in its early stages, mainly driven by the growth of data and emerging AI demand. Overall growth in semiconductor demand is expected to broaden out to other areas, such as electric and autonomous vehicles, industrial Internet of Things applications, 5G networks, and eventually AI-enabled smartphones. Applied Materials is well positioned to benefit from these long-term growth trends, given its immense capabilities in cutting-edge chip manufacturing. In addition, Applied Materials is financially strong and shareholder-friendly, with a goal of returning 80% of free cash flow to investors over the long term through dividends and share repurchases. The company has increased its dividend by nearly 12% annually over the past 10 years, while at the same time reducing its share count by 30%. The stock has a strong track record of outperformance, and we believe there is more long-term potential upside for AMAT due to its unique competitive advantages, strong growth prospects, and significant cash flow growth and high returns on invested capital. Now I'd like to discuss one of Edgemoor's longest-held income investments, Ares Capital Corporation. Ares is a specialty finance company that provides debt and equity financing primarily to private middle-market companies in the United States. With a market capitalization of $13 billion, ARCC is the largest business development company in the country and is regulated under the Investment Company Act of 1940. Ares Capital's investment objective is to generate both current income and capital appreciation by investing principally in first and second lien senior secured loans and mezzanine debt, including in some cases an equity component. As a regulated business development company, Ares Capital is required to pay out 90% of its taxable income in the form of dividends to its shareholders to avoid corporate level taxation. As a result, ARCC pays an attractive and growing dividend, currently yielding 9.3%. Since its initial public offering in 2004, Ares Capital has invested approximately $142 billion in more than 2,100 transactions and generated an average annual return to shareholders of 13%. Ares enjoys an investment-grade debt rating from all three credit rating agencies and has ample liquidity for new investments on its balance sheet. We believe ARCC is an attractive long-term income investment due to its leading market position, conservative investment philosophy, and attractive and well-covered dividend. That concludes our second quarter 2024 presentation. We hope you found it helpful and informative. Please feel free to reach out to us with any questions or comments. Thank you for tuning in, and we hope to see you back next quarter.